Hello, brother.
Hey, Omid, how you doing?
I'm doing well, man. How are you?
Good, good. Welcome back to trading. You've been away a long time.
Yeah, man. I was trading, but I just want to do something and then have a session with you. Just like telling me, okay, do this shit, do that shit. Man, it doesn't work. So,
All right, fair.
Andrew yeah, Andrew make like 190, $91,000. Shit.
Yeah, yeah. 200,000 on just one trade. Isn't that something?
Oh my God, yeah. So today I didn't trade, but yeah, he made like that's amazing, man.
Yeah, yeah. It shows you what's possible out there. He did that without options. It was just finding the
Yes.
most volatile gamma squeeze or whatever it was, and off it goes, basically. And
Yeah.
once every few years, you get opportunities like that, and that's really all you need. Big
Mm.
ones, a couple of good opportunities. Wait for it, and patience goes a long way. So,
Sure,
good stuff.
man. Sure. So, man, for my trading stuff, one thing happened, and there's good thing is my P&L curve was positive until like I just ruined it after these meditation, 10 days of silent meditation. But anyways,
Okay.
yeah, man, 10 days of silence and meditation. So it's yeah, it was 10 days, man. It was something.
Well, that's pretty good. And well, it's supposed to have a good impact on you. So, well, what happened?
No, but like no, I guess I feel really confident and feel so good so that happened. So anyways, I forgot my game plan. So if I just put that one day away, overall I can say I have almost of the time the positive days and the equity curve is slowly going up. The problem is that is so I make like around $200 per day, $100 or something like that. It's not that big. So and I guess the issue is I try to just get in the trades in 1 minute, and all the time I lose like $300, and then I have to just get it back. So this is the theme for last 2 years. So this is so I guess I need to I will stop it, man. I will stop trading at the open because it's not gonna work out. At least I don't have it is like 50-50 things. So if you go up, if you go down, but it's mostly it seems like I don't have a very good game plan for the open. So this is one thing, and the thing that really helps me, I reduce these the what do you call it? So yeah, so in the past, I guess I don't know how much did I risk at the beginning, but now on a good entry, I risk around $200, which is good, but I only get like around like on the best thing that I get out of it is around like 1 hour. So I want to improve that. But the thing that I want to just go with you is the very, very basic things. So I have an account and I have like around $800,000 in it. And I'm just playing with around like $100,000 or like in a good days, $150,000. So there are some laws and rules that say not rules that say, okay, you have to raise like 1% of your account and all of that stuff. I just want to get the money out of that and put it somewhere else and just having an account and stick to the rules of trading, the percentage of what is spend. I forgot the word. So the amount that I'm gonna like percentage that I'm gonna risk. So so what is the rules there? Like that to what they said 1% of the account risk it. So I just want to go on that
Mhm.
thing.
Yeah. So to begin with, risk per trade, let's go backwards. The limitation on it is the account size, right? So if you have a $100,000 account, well, you can't risk more than $100,000. Put it that way. Okay, that's cash in your account, even though you get margin and all that. Basically, you'll get a margin call. Of course, it's not smart to risk the whole account on any singular trade or any single day. So you got to pick a number that makes sense mathematically, like 1% per trade, or maybe 2% per day of the account. Whatever account you put aside for trading, it doesn't have to be, and it should not be your entire net worth. It should be whatever you put aside for trading. That's one side of it. But before you even get into that, really the most important and most practical part of it, when it really gets real, is when you are trading, you're actually in a trade, the risk, the number of dollars at risk should be big enough that it means something to you, as in it's not small and it's irrelevant and you just throw it around. And also it's not too big that it freaks you out if it goes against you or for you. And now that's very individual. And that actually, most of the time, is irrelevant on your account size. You can have $10 million, but to risk even $100, you freak out. That happens to a lot of people. And so you risk $50 per trade, even though you have $10 million in the account. And so in that case, you're not going with that 1% thing. So what's really more important is you got to stay emotionally stable when you are trading. And the most triggering thing for our emotions when we're trading is money. We're looking at the P&L going up and down on the screen. That's triggering. So you shouldn't have that on the screen. Or, the other side of it, you know how much you've put at risk on a trade. And if it's too big, it'll freak you out. If it's too small, you won't pay attention to it. And either way, you're not trading well. So it really comes down to your relationship with money. And that's a very, very personal thing. And that's a bit of an exercise at times. Sometimes you'll try, okay, you'll risk $50 per trade, see how that goes for a week. You realize, okay, it's too big, I'm freaking out. So you drop it down to 30 and try that. Then you find yourself more stable. Or you find 50 is too small, it doesn't turn you on. So you go with something like 70. Try that for a week. And now you realize, okay, now I'm feeling better about it. Or you go to 100 and you realize, oh no, I'm freaking out. So you give yourself a week of attempting that stuff. It's a little bit of trial and error. And you pay a price for that, as you pay a fee, the few losses you make during that week. And then you find the number that fits for you. Then the fun starts, because now that you have the number really ready to go and you're comfortable trading that amount, then what happens, as you get more consistent with your trading, you size up. Now, size up doesn't mean, size up, I'm talking about maybe 6 months later or 3 months later, once you have consistency and you're confident with it. Now, size up does not mean you suddenly just increase your risk per trade. That's not what I mean. What I mean is now you start adding into your positions before you even take a profit. So you get in, let's say $50 risk, and then the trade works in your direction. So now you have confirmation it's moving towards your target. On the way to your target, it's claimed a new level. That's using, let's say you're long, it's using another level as support. So you can actually move your stop loss to that new level now. In that case, you have an opportunity to add into that position. So what you've really done is you ended up taking a bigger size without increasing the dollars you put at risk. So you're only adding in as it goes in your favor. That comes a little bit later. That is actually scaling up. And that's actually the safer and healthier way to scale up rather than just going bigger risk per trade. That's where a lot of people lose it. So that's the kind of eventual growth curve that should happen when it happens nicely, organically. So to begin with, really, you gotta kind of be very introspective and assess your relationship with money and figure out what is that dollar number that you can trade with that's not too small and not too big. And then on top of that, the only limitation is the account size, which typically for most people is not a problem, because the relationship with money is a whole different game. Like I said, the bigger problem, and that tends to be people have too much money and they start risking it all. They should not be risking $100 per trade because they freak out. Should be risking 50. For a lot of people, it's like that. Or they should not be risking $1,000 per trade. They should be risking like 600, whatever. It's different for everybody. Usually the account size is not a problem. Everyone thinks the account size is a problem. Generally speaking, with the experience I have with everyone I work with, that's really not the real problem. So kind of take your time and think about that. Now, the relationship with money, what's really important is that it's gotta be like a relationship with a person. Just think of what is a healthy relationship. It should be that one party isn't controlling the other party. There should be respect in the relationship. You got to give each other space when you need space. And you got to be caring for each other. There's a time for that too. So all of those things are part of a healthy relationship with a human being. Think of that, all of those elements that it takes for a healthy relationship. And now apply that to your relationship with money. Does it control you? Well, that's not healthy. Do you control it? Are you over controlling the money? Well, that's not healthy. You know, there should be some mutual respect there. You can't just toss it around and disrespect it either. That's not healthy. And it shouldn't do that to you. So you got to assess where you are with that relationship and make it healthy. Now that's a practice, as in a daily practice. How do you conduct yourself every day? And once you make a decision that, okay, from now on, I'm going to do things this way. I have been doing things this way. I've been over controlling with money. I haven't been spending it. I've been really careful about saving it. What you've become now is over controlling. So you got to loosen that up a little and make a clear cut decision. Okay, I need to make this healthier. And then if you make that decision, then conduct yourself that way. And what you find is when you conduct yourself a new way every day, to begin with, it's rules and discipline. But then in about 10 days or 2 weeks, you do it every day, it becomes instinct. It's no longer rules and discipline. You're just doing it out of habit. And then you'll bring that instinct, that new habit, to trading when you're trading. And you're trading now with a healthy relationship with money. And then you'll see the difference. You'll see you're able to hold your trades better, that you don't stop out prematurely, you don't take profits prematurely. You enter when it's the right time, you wait for your entries, all of those sorts of things. That starts coming into the picture. So it's very, very kind of subconscious stuff that you got to do outside of trading. When it comes to assessing money, how much should you risk on a trade? All of these things come into the picture. And your trading really evolves when you start looking at this stuff. This is more important than looking at moving averages or another indicator or something like that. You know, those things are simple. This stuff is more powerful.
Totally agree with you, man. So even in that, yeah, I just working on this relationship with money for years, and sometimes I get tired of it because it's not getting
Okay.
better. It's just like up and downs, just better,
Yeah.
worse, better, worse. So yeah, so even for me, it was shocking in that trading thing, in that meditation thing, in that 10 days of silence, and something just pop up that because in the past I ruined money, not ruined money, but like let's say I spoiled the money a lot, and money brings me power, and I was a really egoistic person with money.
Mm.
So, and I really work hard for the past 4 years to just be a human being. And in that meditation thing, so I saw myself to be successful again and making money and all of that stuff. I would get back to that attitude. So for me, is that is one thing that I have to just focus. And even like I was talking to a therapist about it, and he said, okay, um, in your world, do you know any successful and rich guy that he's a very good human being and he's not egoistic? Like, and I said, no.
Yeah.
So for me, it's a little bit different than that. So, but I have to find out the people that they are really kind and nice and successful and making good money. So for me, all the people around me are a bunch of assholes. So,
Yeah, yeah, no, that's a good one. It's actually really, really important. It's about your environment, the people you keep in your life. Are they toxic,
mm,
or are they really a good influence on you? Because the truth is, you're gonna end up being like the people you spend your time with, whether you like it or
sure,
not.
man.
They have a massive
Mm,
impact on you, sharing energies. So you got to be very, very picky about who you keep in your life, who you interact with regularly. I know that can be really rough to cut people out, but that is kind of what it takes if you want to step away from the crowd and be an outsized performer. Those are tough things to do. Now, everybody who's found success in anything, that's what they've had to do, including musicians, athletes, big business people, all of them. They got to step away from the regular crowd and put themselves in a different category of people. And those are sacrifices you got to make if you want those results. Because that is a massive influence. You got to understand, we are social creatures. We influence each other. So you will be influenced by the people around you, whether you like it or not. So don't try and control that part of human nature, but take advantage of it by surrounding yourself with seriously good people who have the qualities that you want to have. Spend time with these kinds of people. Go to those kinds of conferences or meetings.
Mm.
That's where it counts. And it really counts. The thing about ego and money and it controls you. Basically, it controls you in that sense. So that's not healthy. I
It is
mean,
not.
just because a guy makes $1 million doesn't mean you should just go buy a Ferrari. Yeah, it's in that case, it's more materialistic and egocentric rather than a different purpose for it. You know, making money, there's nothing wrong with it. I'm very supportive of that. Make it, but it shouldn't control you, and you shouldn't control it. You know, so I'll give you my example. What I like to do is I don't make money to go out and buy stuff. I generally don't like that. A majority of it, I invest it back into the longer term portfolios for the future of my children. That's what I'm doing. I'm not out there buying all kinds of toys, boats and yachts and cars, and not so interested in those things. If I want those, I can rent it for a day, and the fun is gone. That's it. You enjoy it, and you're done with it. If you really have that craving, you can actually do it in a cheap and simple way and get it out of your system. It's not difficult. So there's ways to even, comfort those urges. You indulge just for a little bit. You don't have to go and throw away everything on it and then put it all over YouTube. Hey, look at me! I got a new car and a boat, all that stuff. It's unnecessary. So you got to make sure it doesn't control you. You got to kind of remind yourself, why did you start doing this in the first place? What was the whole point of this? So if it was about the Ferraris and all, well, okay, at least you know what your purpose was to begin with. But if it became about the fancy cars after you made money, then you've lost your direction totally. It starts to control you. So you gotta kind of stay true to your, purpose. Otherwise, you really will lose your way. And then you won't recognize yourself in 5 years. You wonder where you are in life and what happened, why all your relationships fell apart, why all this shit happened. You'll get lost. Basically, you'll get completely lost. And that happens to a lot of guys. Happens to a lot of people when they start making money. It's actually common. These are traps that we fall into.
When it happens to me, like, man, I was like trading options really aggressively, but mostly I just like go setting spreads, all of that. I was really good at. But yeah, at that time I was like kind of different mindset, I was like, but then I start to spend it on stupid stuff like shoes, all of that, clothes and all of that, and then I lost it. So yeah, in the past, I didn't know my story, but man, I was like in petrochemical stuff, companies, I was dealing with Iran, around the sanctions, all of that stuff.
Mm.
The connection that I have, all of that makes me nuts. So
Yes.
yeah, so even yeah, for me has finding but thinking about it. It's all about like what I think about the money and all of that. So yeah.
Yeah, it's very interesting. It comes to conditioning as well. Like your background from Iran and everything is a certain type of conditioning that you've had since you were very young. That's very different kind of conditioning than everyone else. Like other people would have had, let's say they're born into millions of dollars in Connecticut, for example. There could be others who are born in Sri Lanka in the 70s and 80s, through the 80s in the Civil War. They had a different thing where money meant security and the ability to escape the country and avoid the Civil War. So there's that. Then their conditioning is all these people have different conditioning. Everyone, all of us do, every single one of us. And that dictates a lot of how we interact with money in our lives, a lot. So there's no like one rule for everybody in that case. Everyone's conditioning is different, so everyone's priorities are different. The person who was on the streets during one of these wars and all that, then if they finally found a way to make some money, escape the country, and they grow a business and keep making money, that kind of person is very unlikely to go and indulge in yachts and cars, even with millions of dollars, compared to the other person, born into it and inherits plenty of it at the age of 15 and 18 or 20. Well, that's different, totally different attitude with the same amount of money. And there's no right and wrong here. It's just you got to be aware of conditioning. And then whatever your conditioning is now, you bring that to day trading. And you can see who's going to be throwing it around in the market and who's going to be really sharp about what risk they take and when to take it and being more secure about it. You can just tell it comes from that conditioning. Just look at somebody's history in that sense. I'm not saying history of how they conducted themselves. I'm saying history of what was their environment when they were very, very young. What were they born into? That history. That's kind of condition. And then when you come to trading is very revealing, right? It'll reveal all that stuff, and you'll have to look back at your conditioning once you realize, oh, you're making losses, you're throwing money around, or you're not able to take a trade, you're too afraid to risk money. And it all goes way back to that subconscious stuff that was ingrained when you were a small child in your environment. That stuff really comes out because trading is very revealing. It'll bring out so much stuff. Again, this is far beyond technicals. Technicals, you already know, volume, candlesticks, that stuff. This is something else.
Yeah, technicals. Yeah. You can't just teach everyone technicals in 5 minutes, but man, apply that is really hard. So that's the subconscious mind start coming about.
Yeah, and there's actually a very good relationship here. The technicals that you use or don't use, let's say the technicals that you use does have a massive impact on you emotionally. They trigger you. And you could have, everyone's got different triggers. Again, depending on your environment that you come from, on your conditioning. So you got to then identify which technicals actually trigger you to take the right action that you want to take and which ones trigger you to take the destructive actions. So somebody might be getting excited when they start seeing a price holding a moving average. And every time it touches a moving average, they want to take a trade, end up over trading. And so that trigger, that moving average is a trigger for that person. And it's triggering that person to take too many trades, end up blowing up the account. So that moving average should be removed from that person's trade, from that screen completely. Because that's a no good trigger. It could be now the same person, when this person watches the price hit a horizontal level, let's say on a bigger time frame, on a weekly chart, for example, or something like that. Then this person actually starts watching the price very carefully and watches what the price does at this level. Does it bounce? Does it reject? Does it break out? What is it doing? Is the volume coming in over there? If this person is getting triggered into that kind of thought process as the price hits a significant level on the chart, well, then that's a pretty good thought process. You're thinking about risk management. Should I risk money on this trade? Is there going to be a good reward as it punches out from here? Those are the kinds of thought processes you want to have as a trader. And so if the price hits this level and this level thing triggers this person to think like this, then that's an indicator that person should have on the screen, because that triggers the right kind of actions and right kind of behaviors for day trading. So there's that relationship. You want to be really, really picky about that and figure out which triggers or which things on your screen trigger you for the right actions and which ones don't. So you're not really going around and trying to change yourself. That's not the whole point. Firstly, you got to be aware of yourself. What's your background, what's your relationship with money, all of that stuff. And then put the right triggers on the screen so you can take advantage of yourself, of your own traits. And everyone's traits are different. Instincts, personality traits, all those things. And so with the right triggers in place, off you go. You'll actually just only take trades off of those particular triggers. And you'll find that you'll have a 50% win rate, 50-50, but your losers are small, your winners are big, you make money. So that's really how that works. And again, everyone's different. I can use so many examples. There are people who are more aggressive, as in they like to get into trades. So they should have less triggers on the screen. So that kind of holds them down a little bit, holds them back a little bit. They wait for it to get to a level. Other people, they're so conservative, they struggle to put a risk on a trade. So these kinds of people perhaps need more indicators on their screens to get more and more and more confirmation. When all 5 or 8 triggers line up, then they'll take a trade. Okay, so it's a different kind of person. Totally. So which strategy is right for you? Well, it's not one fits all. It's very much custom designed. It has to be. Absolutely has to be.
So yeah, for me, like take time to yeah. For me, man, I guess I should not take it. Actually, we had this conversation, I guess maybe 8 months ago. I should not take a trade in first minute, but I don't know why I keep doing it. So it's the triggers that I don't take. So let me just show you one some of my trades. Let me just share screen.
Yeah.
Um, not this. Are you seeing anything? Let's stop share that. This is not fun. Let me just bring this stuff. Yeah, but man, it's like the theme, I just lose money in the first 3 minutes and then I get it back. Like it's easier to not trade.
You know what's amazing? That's exactly how I used to be. I have the same personality traits as you. Like I've seen your trades, and I have the same. Had them, and it's taken a while to work with them, and I'm still working with them. But you can draw some parallels here.
Man, what did you do? Like you stopped this curse.
Yeah. Well, I removed the triggers. I used to
Hmm.
get in the first 2 seconds after the market opened. That was crazy. It's too much.
Can you see it now?
Yep, I see it. What am I looking at?
So see, first trade again, this happens a lot. So first trade, in here, I stopped out and then I get it. Bum bum bum.
Mm-hmm.
So I mean, let me show you the other ones. Like these are happening like every single day. So it's where I cannot. Okay, better. So this one is terrible. No, this one like that was my all that was the what I've been not good. Let me just show you the good traits. Not these ones. Let me just go back. Again, no, I just want so let's say for example this one.
Mm-hmm.
Oh, this one I first short and then no, this one is terrible. Anyways, not this one. Sorry. These are oh yeah, for example, this one. See, I just get in, add, and then I chicken out, and then I just get in, and then I just get out, and then I just get in and just go with it. So these are the things. But this one was actually good again compared to other ones that I do at first minute. I just want to show you these first minute ones.
Mm-hmm.
Like, yeah, so this one again, 931, just got in, got out. And again, second trade, got in, and then add, and then it was a good one.
Yeah.
But the third one was stupid, like going, um,
Let
going,
Let's go through
more-
this. Let's go through this. This is a good
sure,
exercise.
sure.
Let's go trade. The first trade, what okay, what triggered you to get in?
So what triggered me to get in? So I saw that big candle, right? So I had two things was here, like, I saw two dojis, at some level they just bought back. Okay. And the next trigger was it touched the VWAP and then go up. So I guess if I get in at the VWAP level, it's gonna be better. So but it touched the VWAP and the moving averages, and I thought, okay, it's gonna go up. And then I just stopped out.
Mm. Okay.
That was the
Now,
trigger.
okay. Look at the distance between your entry and your stop out. Okay. Now, when you know the distance right there between the entry and the stop, what you need is the reward side to be a minimum of 3 times.
Mm.
So now look at how much distance it has to move to go 3 times.
A
It's
lot.
massive.
That's another issue that I got all
Yeah.
the time, get 1 hour, half hour in my trades.
Because your risk is too wide. There's almost no way it's gonna go 3R, and 3R should be a minimum from your distance, your risk distance. It's far too much. So just based on that, even if you see it's bouncing off a level and it's claiming VWAP, it's going through pre-market, you're seeing all this. But then when you're entering, the last thing you gotta look at is risk versus reward. And if it's not aligned, don't take it. And here's the thing, I'll tell you about that. Risk to reward is a one singular thing that actually overpowers any strategy. I'll make that really clear. Like, take a coin, toss the coin, heads or tails, 50-50, right? Okay, you don't know if it's gonna land heads or tails, you just toss it. All right, let's do this. I'll make you a guarantee. If it lands on tails, you lose $1. If it lands on heads, you win $3. Fair enough?
Yeah.
Okay. So let's toss this coin 1,000 times. And it's 50-50. In the end of it, did you make money or lose money?
Just make money.
Yeah. And look at that. You made money on a bullshit strategy, a coin toss, 50-50. You made money. How? Why? Because you guaranteed risk and reward. That's why. That's how. So even on a bullshit strategy that has no basis, no meaning, no reason, you still make tons of money. A lot. And so what you can do with that is apply that to trading. What that means is when you're taking a trade, make sure that your risk to reward is something you have absolute control over. And I tell you what, that's the only thing you have control over in the market. Because the market doesn't care about you. Market doesn't have to give you a setup. And even if it gives you the perfect setup, it still doesn't have to work out. The market does that all the time. It gives us perfect setups and it fails. Even these setups are all 50-50. So you got to think that way. Every setup, every trade, every entry you take is 50-50. There's nothing more than a coin toss. So picking a strategy is nothing more than picking which coin do you want to toss. The gold coin, the silver coin, the copper coin, nickel, whatever. It's irrelevant. Just pick your coin and then control your risk and reward. That's how you make money. Really control it. So when you're entering or before you're entering a trade, look at where you're entering, look at where your stop needs to be, and look at where your target needs to be, or look at where your target is. And gauge it right away. You don't have to sit there and calculate, just gauge it. It should have lots of room to run. 3-1 is a minimum. You should not be taking 3-1 trades. It should be typically 5-1, 10-1, somewhere in that range. That's the potential reward. And then if you take only trades like that, it's 50-50. Let's say 50% of the time you stop out. The other 50% of the time, let's say it runs 5R, 10R, perfect, you make plenty of money. But let's say out of those ones that start running, not all of them go to your target, some of them go halfway. Okay. When it's going and it goes halfway and it's struggling to go, you can take half your position off. And you're still taking it off at something like 3 or 5R. Because to begin with, you had a massive risk to reward. So there's a safety built into that as well. It goes just 1% more than that coin toss. So really all these strategies and indicators and pivots and moving averages, all of this stuff, it doesn't give you an edge. It's not that. The edge really is, can you control risk and reward? And here's the fun part. When you start doing this, when you really start controlling risk and reward and only entering trades that give you massive risk to reward, what you'll find is you will not have any fear of stopping out anymore. You'll realize that you have to stop out half your trades. Maybe even more. You'll stop out 3-4 times and then 1 trade or 2 trades will work. And that's it. That's plenty for the day. You can make so much money with a 30% win rate without a problem. So much. The only thing you have to do is guarantee risk and reward to yourself. So you
So
need the right kind of triggers in place that help you guarantee the risk and reward. If you're getting triggered here, looking at your charts, you're taking trades off of so many moving averages that are just basically overlapping each other. Well, you're way over trading. And you can't control risk and reward. You're basically going long every time it looks like it's holding a moving average of VWAP or something. Right? Without considering where can this possibly go to? As in, where's the reward side? And the thing about moving averages that I don't like is that they're moving. So if you're using them for a stop, well, they're moving, and so it becomes a little more difficult to gauge your risk to reward. It's not as firm as just a flat level. Just psychologically, makes it a little easier. So, but hey, some people work well with moving averages. So if that works for you, fine. The point is, you need the indicators that really allow fantastic risk to reward. And what you'll find is when you start doing this, you'll trade a lot less. Because the opportunity is not going to come to you every 2 minutes like it looks like on your chart here. It'll come to you maybe 3 times in the first 15 minutes. And that's plenty on its own. That's a lot already. 3 trades in 15 minutes, that's a lot. So really, trading becomes a lot slower. That's when you're doing it right. You're controlling risk and reward. You're only entering if the market's making you a good offer. A good offer is really good reward for a little bit of risk. That's a good offer. Somebody makes you a good offer, you take it. Somebody makes you a bad offer, you don't take it. It's a simple thing. Just like that. Same thing in the market. If it makes you a good offer, that's when you take the trade. And then accept that you might be wrong. 50% of the time you will stop out. The rest really win.
yeah, so for me, it's like risk reward is really off. Even let's say for the next trade, I just wanna 1.5 hour, right? So that one was like I see these that Andrew really used and I really like it. So 5 minute engulfing. So I saw that and then I take that trade. Even with that, it's just like even I add to it, I just get a 1.5 hour, even not 2 hour.
Mhm.
And if you see the next one, let's say the third trade, that was like, let's say I went short.
Mhm.
See how big is the stop is?
Shit.
That was
No,
1 hour. So just getting even 1 hour in that trade was make it impossible,
mhm.
you know?
Yeah, yeah. You're getting. Let's look at that engulfing one at first. Do you realize there's something you didn't see that would have kept you out of this trade? Any clue?
Um, I can say I maybe the VWAP. I no, I just get in at the
Okay,
VWAP.
look at the first 5 minute candle. Look at the very top of that candle where your yellow line is on the 5 minute chart. Okay,
Okay.
that's where
Yeah.
it went up and it rejected from there.
Yes.
That's telling you right there that there's big sellers up there. I mean, and look at the wick on that candle, that first 5 minute candle. It's got a big wick there, big strong sellers, and you're going against them.
Yeah.
Okay, that's it. That should have kept you out of the trade right there. Simple enough. That would have
Mm.
kept you out. On the first trade before that, what would have kept you out is risk to reward. You can't get this thing to run $10 to make that work.
Yeah.
So that would have kept you out. And the second one would have kept you out is that big wick on the top side. There's sellers directly overhead.
Mm.
Until they break out, shouldn't be trading into that. And then what have you got? You added in, it looks like. Yeah, you got 1.5 hour. And then you took another trade, what about 952? It looks like just above VWAP. And you know what would have kept you out of that trade? Is you're taking it above VWAP, but look from the open. What is it doing with VWAP? Up, down, up, down. It's just crossing over VWAP. It's not respecting VWAP.
Mm.
You see, all these moving
Oh, okay.
averages, you can't use them blindly. That's the problem with indicators. You can't use them blindly. You got to make sure that the price is respecting them before you trust them, before you use them. Any indicator, any single one. So we always say go long above VWAP, short below. Well, that makes no sense. You got to make sure first it's respecting VWAP. Otherwise, it's just chopping up and down every time you enter. So you're trading like a, what is that? That high frequency trading algorithm. Yeah, which most of them lose money. So, that's the thing about indicators also. You have so many of them that then you got to identify which ones are actually working today on which stock. That's more work. You can get all wrapped up in that, and I don't recommend that. You see, your trading style should be so simple that it only takes 10% of your energy to identify the indicators and the levels and whatever you're looking at. Because you need 90% of your energy to focus on risk versus reward and manage your emotions while you're trading. That's where all your energy should be going. But if your trading style is so consuming, you're looking at 4 different moving averages and VWAP and 2 multiple time frames, I don't even know what else. You're consumed by all this stuff, and you don't have any energy left to manage yourself and your risk to reward. You're just getting excited every time it hits a moving average. This is actually a really good example. Let's look at this 1 minute chart and imagine it without any moving average, okay? Just imagine it if you can right now, without even the VWAP, okay? All that spaghetti on the chart, that's gone. All you've got is basically candles and volume and a few horizontal lines. That's it. All right. So let's say this thing opens. The first minute candle is a doji. Okay, it's a doji at whatever that little line is. Is that the opening price? I think you've got there.
The green one is the opening price.
Okay, so you got it. So you can see the first candle, it just chops up and down the opening price. That's the only indicator you have because there's no moving average VWAP, nothing, right? So it chops up and down. So right away, as the first candle closes, you realize you can't trust the opening price. It's not respecting it, straight up. Second candle, what does it do? It opens right there at the opening price again, drops down a little bit, and then shoots right up, basically a 1 minute ORB kind of setup. It goes up through what looks like pre-market high, okay? And it does that very quickly. It's an aggressive, strong, fast move, lots of volume, everything happens. Okay. And now what you want to wait and see, is it holding that pre-market high? Because realistically, if it's holding that pre-market high, it has lots of room to run above that. Your next level looks like it's 153.50. Looks like it. Okay. So if you identify that above that opening, sorry, that pre-market range, the next target or the next line you have is far away. Now you may have an opportunity. So let's say the second candle, it breaks out of pre-market high. It closes. So that's a breakout candle. What you want to do is to confirm that that was pre-market high, so that it was resistance. Now you want to confirm that it is support. If it's holding it as support, you can take a long. And the long would be if the next candle after the breakout, that third candle, comes down to pre-market high, bounces off it, then you can take a trade, as in bounces 1, 2, 3 times within the candle. You can see it. It's coming down, it's bouncing. It's coming down, it's bouncing. You see it bouncing 1 or 2 or 3 times. You can take a trade just above pre-market high, stop loss right below, very tight risk, very tight stop. That should give you like a 5 to 1, 10 to 1, going up to 153.50 or whatever it is, whatever your next target is. And those trades you shouldn't have any problem taking, because if you stop out, no big deal. You lose 1. If it runs 5 or 10. You see, so you can take those trades 5 times and no problem if you stop out 5 times, because you know that these work. So that stop loss in this case would have been right below that pre-market high level. And you probably would have stopped out right away within the candle itself, most likely, if you had taken that entry. And where you entered right there, that it wouldn't have been that entry. It would have been much closer to your red line, because you're really controlling your entries, as in you want a really tight stop, because you need to control risk and reward. See, so that first trade would have been a much tighter stop, but the reward opportunity would have been huge. Much, much, much bigger. Now that one makes sense. That makes a lot of sense. It has the opportunity to run. It doesn't have to run very far from there to give you a 5 to 1. This is actually a very quick trade. If it goes, it's great. And you're not getting triggered by moving averages. You're just watching simple levels. Once it clears a level, what's the next level? Okay, that's the target. Off you go. So just in those first few minutes, you would have seen that. Now let's say that fourth minute, it comes back down through the opening price, and you know you can't use opening price because it's not respecting it on this day. So just let it go. It goes all the way down. Looks like you have R4 down there. It breaks down through R4, right? With some decreased volume. The candle that actually goes through has lower volume than the previous candles, but it still is a big candle. So that's a bit of a strange thing. If it's a big candle, it should have big volume, but it's not. The candle volume is decreased compared to the previous ones. So this move is not likely to be sustained. And then sure enough, next candle is a white candle. It goes up, right up through R4. Okay. And look at this next one. Very interesting. It opens and actually comes down towards R4, gets close to it, and starts getting pushed up again. Now, there you have an opportunity to take a long. Because to begin with, you know that that move down through R4 was not genuinely going to be a sustainable move. It looks like a false breakout because the breakout happened with low volume. A genuine breakout of R4 that would have been huge volume should be much bigger volume than the previous candles. This actually came down on low volume. And then the next white candle closed above, and then the next trade you can take, you enter just a little bit above R4, stop loss just below it. Now look at the risk to reward as it goes up to pre-market high. That would be ideally like, it looks like 8-1 if you get the right entry there. Something like that. Basically lots of room to run. Now imagine that you're not using any moving averages in this case. And you're not able to use the opening price because on this day it's not respecting opening price. It's just going up and down. It's just chopping it up. So that could be a possible entry. If you believe in R4 as a level, that's a level you like to use or can use. There you have a trade. And see, you're really getting involved here. In this case, not using moving averages, just using these levels that you have. So you're removing half the triggers, really. You're just going level to level. And then it starts to make sense. You're able to control risk to reward. But instead, what you're doing is you're getting triggered on these moving averages, which are really, after the first 2-3 minutes, it goes up and down these moving averages 3 times or something. You can't trust them at that point. Really, after 3 minutes, you can tell. Or after 4 minutes here, you can't trust opening price. You can't trust the moving averages. It's telling you that right here. But if you're not able to see it, you just blindly trust them. Then you got to remove them. Because right now it looks like you're just blindly trusting these indicators without confirming them, and that's messing you up.
Yeah, what do you think if I just remove all these moving averages just as a test and just having the VWAP?
Yeah, remove it. I did that. I did that about 2 months ago. I removed that, just only the VWAP, and now I've removed that as well. So it's just
This is
candles and
what,
volumes.
yeah,
See, the
this
thing
is
is,
how, yeah,
you're
good
getting
thing. Yeah,
very
yeah, keep
triggered.
on.
You're getting so triggered. You need to slow it down. Remove the triggers that are triggering you into this trading with poor risk to reward, with trading with over trading, just getting involved. These indicators that you somehow trust blindly, they're taking you for a ride. You don't even know it right now. That's the problem.
Yeah, even like for me, I'm seeing my trading is I have to just see for many confirmation and then get in. And that makes me to have like a very terrible risk to reward. So all the time it seems like my win rates it's more than my loss rate. So but the thing is my risk to reward is terrible. That's why I'm not making money.
Yeah.
So because there is one after this boot camp stuff, not boot camp, like that seminar things at the Vancouver. I just I make these one group, 5 of us trading. So they are doing much, less. They are not doing good at all. But when they win, they just win like 4 hour, 5 hour. But for me, just I win a lot. But my R is just like 1 hour, 1.5 hour, half hour. Just like if I just make
Yep.
that happen. So the triggers for me, yes, you're right. And also I'm looking for many um indicators and then I do the trade. So that is not good. So yeah, I will work on it. Let
It's
me
simple
just
for you. You remove the triggers and at the same time start controlling your risk and reward. Absolute control. So do not enter unless it gives you a massive risk to reward opportunity. Massive means 3 to 1 is a bare minimum. You should not even be entering 3 to 1 trades. That's a bare minimum.
what is the
Should
bare minimum you said? 3 to 1?
3 to 1. So you should not be taking 3 to 1 trade. That's just bare bones. Not worth your time. You should be taking trades that have massive room to run. You don't need to sit and calculate that. Just look at the chart. Oh, look, the next target, the next level is so far away. Okay, take it.
Yes,
Then
it
it makes
is.
sense. That's when it works. Yeah,
So
let's look at one of the others. Yeah.
let me just check the other one. This one is 3 minutes. This is Meta. Yeah, this is terrible. Oh, so let's check this one, let's say.
Mhm. Right.
So yeah, so I just get in and then I stopped out. I don't know what just happened there. Oh, let me just put the battery on. And then I just got in and I'm 100% sure this is not more than 2 hour trade. 100% sure.
It should have been 10 hour.
Yeah, it is. It's only yeah, my best days is like 2.5 hours. Even when I add and all of that stuff, but like yeah,
Mhm.
so same thing.
Okay, let's look at this. Let's run the same exercise. Imagine there's no moving averages. You just have these
Okay.
pivot levels. And so the thing opens, again, it chops up and down the opening price. Okay, so you can't trust it. It goes down, it hits about 139. Find some buyers. Let's say you didn't have 139 marked on your chart. Okay, you didn't identify it as a level before the market opened, so let it be. It goes down, it starts coming back up towards the opening price. And then it goes and it breaks through the high of the day, which is the high of the first candle, right?
Yeah.
Okay, it breaks through there. When it breaks through there, it runs into S5 pretty quickly. And then consolidates and basically retests that opening range at about 940. Those wicks at the bottom, those two hammers, basically testing that opening range. And then it jumps and breaks out through S5. Very interesting. Now, when it breaks out of S5, it sits there just around S5, right? Basically testing the level, retesting it. And then it starts to run. Now, that's where you can possibly take a trade. If you trust these pivot levels, you would enter a little bit above S5 as you are sure that it's holding S5. Stop loss on the candle right below it, or right below the entry candle itself. And then you run that thing up to the next level, which you have S4. And look at that risk to reward. That's 5 to 1 as a minimum.
Yeah. No, just even I can tell you, I remember this trade. So I just get out entirely at like that is five things, and then I get into again. And
That's
very small size. I remember that. I remember
yeah.
that trade.
Let's try this one more exercise. Now remove all the lines, okay, in your imagination. No pivots, no moving averages, none of these auto marked lines, nothing. It's just candles and volume. That's all you've got. All right. What you find is it opens, it goes down, it bounces off 139, it comes back up through the opening price, it breaks out of the top of the first candle, basically the opening range. And when it breaks out of the opening range, it retests the opening range at about 940, those two hammers. And you can enter once you see those hammers conclude, you can really see that it's testing and it's holding basically above the opening range. It's not getting pushed back into the range, it's getting pushed out of the range. And you can enter right about there. The stop loss can be very tight. And then you're running it up through big round numbers. 145 is the obvious big round number. We got 143 and 144 on the way. Those are targets.
You know
Those are
what?
very powerful targets.
For tomorrow for 1 week or 2 weeks, I remove everything.
Mhm.
And maybe I can only focus on the price and the volume.
Yeah,
And
very, very
maybe
powerful.
let's see how it goes. Let's see how it goes. Yeah, I will do that. And also I have Bookmap too. So Bookmap give me the targets.
Yeah,
It's
perfect.
not a bad idea. Let me just do that. Yeah, you said it's too much stuff there.
There's way too much going on. And I tell you what you're talking about doing, I've been doing it for the last 2 or 3 months, this exercise. And in the process, I've removed every indicator. Now I only have candles and volume. And I've even removed every ticker. Now I just trade the spot with options. That's it. I don't even look at it anything else. So this GME went up mad yesterday. I don't even know what I found out later. It's very profitable. I'm not getting triggered into all this stuff because I'm like you. I have this thing when I look at moving average, I want to get involved right away at the open. I want that aggressive move, but it's a loss making business if you do that. So
Yeah.
really simple stuff, and yeah, just candlesticks, volume, and you know how to identify ranges. You know how to identify a breakout. If it breaks out, it should have increased volume. The retest should have lower volume. Once you confirm the retest, okay, we can enter. It's breaking out of that range. It's good to go.
Hmm.
Should be simple enough. If you want, we can go through one or two of those exercises right now. Um, the 1 minute chart, yeah. Oh yeah, look at that. I got some information here. Here, I'll share my screen. This might be useful for you.
Sure.
And
In this Tom Hooker, do you know that guy, just Big Loser Wins? He wrote the book, Tom Hooker.
I have no idea.
Oh man, just read his book. He traded the same way. He didn't he didn't use anything. He
Really?
just nothing on his
Yeah,
charts.
amazing. It's great. It's easy. Okay, here's Tesla yesterday. Okay, you can see the first candle. This is 1 minute chart. Second candle. So it's forming a bit of a range. As it starts to make this range, you can start drawing it there. That's the top right there. And you're starting to have a bottom right about there, right? Start identifying the opening range. Just looking at candles and volume, nothing else. And it looks like it went down a bit. You can adjust your range, like, okay, that's kind of where the opening range is. And then when it's ready to break out, looks like it breaks out, volume really increased. Look at that, boom. So that's a genuine breakout. If you're able to identify that, you have an entry there, stop loss there. Bookmap will tell you where the targets are. The obvious big target is 175, round number. And you have these numbers on the way. Nice and easy. The other way to do it, simple calculation, is a measured move. So look at this. You have 169. At the top there, let's say 170.50. So you have $1.50. That's the range. So $1.50, you add it from here, 170.5. You add $1.50, what do you get? 171, you get 172. So you can put a target as 172. Where is it? Right about there. That's a target. So let's say you enter here, tight stop. That's your target. You're just measuring move. It's a measured move. It's going to give you 5-1 with a tight stop. No big deal. And it hits that target pretty quickly. There you go. Look at that. It hits that target. What happens? It struggles at the target. So you can see that's a target. Next, it does a breakout of that target. So what would be the next target? Well, the same thing. You have $1.50 from here. So this is the $1.50 range. Hit a target. Then the next $1.50. 172 was it? 173.50. Look at that. Boom. It hits that target. You can even take an entry here or even an add and go for that target. Then after that target, what's the next target? Another $1.50, you end up at 175. Look at that. The whole thing just moved, and that was basically the top. So very simple. Range, breakout. Ideally, you get a retest of the breakout. In this case, you didn't. So you can enter the breakout, tight stop. You have a target. If you're convinced that it's going to break out of this target, then you can enter for a new trade or an add to your existing trade. And you know the next target. It's just moving in $1.50 increments.
So
This is
how do you
all done
calculate
just
those range? How do you calculate those range?
you just look at the first range, the opening range. When it makes a nice opening range, you just look at the distance. Here is what 170.5, and the bottom of the range is 169. So that's $1.50. You just approximate round numbers. You don't have to be precise with decimals. and try and
Okay.
use round numbers. This one lined up nicely with round numbers, 172, 173.50, 175. Simple
So
round
can you
numbers.
show me another one with the range? Let's say whatever moves today.
Yeah. Let's look at, let's go further back on Tesla. Here we go. On this day, uh, okay. So here it opened. You can see the opening candle. We can put the top right there. And after a couple of candles, you can see the bottom's right about there. You probably would have drawn it here, then you could adjust it. It's there. Okay, now look, it's bouncing right back into the range on this candle, the fourth candle. It's pretty much confirming that it's inside the range. This is your range. So if you have this as a range, you're looking at 175, let's say about 172 here, and about 170 here, 170.5. So you'd be a little conservative here. You have, let's go with $1.50. Consider this 171.5 and 170. $1.50, approximately. You don't have to go precise, just give yourself a little bit smaller. So $1.50 from here, 171.75, what do you get? You get 172.5, you get 173.5. Is that right? Yeah, that's about there. No, I got that wrong. 171. Oh my God, my math is so bad. I can't even calculate. What are we looking at? 170 and okay, so $1.50.
Okay.
So it ends up about there, 173.25. All right, that's the range. That's distance here. I just put it up here. So if it breaks out, that's a target. Measured move. Right? And look at it sitting. Okay, it breaks out. Not really, you can't be convinced, but maybe you're convinced of a retest. You can enter a retest. You might get stopped out. You enter a retest. You have a few opportunities to enter. Tight stops such that the target is 5-1. Sure enough, it's the target. Look what happens. It sits there. That's a target. This is the move you capture. You get a tight entry. Breakout, retest, off you go.
Hmm.
That's it. Same thing. You just keep going all day. Same thing on the downside. You calculate the distance here, the opening range, and you go. So what this ensures also, by the way, is it keeps you out of the market for the first few minutes, first 5 minutes, because you need the time to identify the range. So you could have a rule, you don't touch anything for 5 minutes. You wait for it to form a range. And then you calculate the move. And you can use bookmap to confirm that that's a target, 173.25. There's something sitting there, 173.5. These are approximate. So if bookmap tells you it's 173.5, not 173.25, okay, use that. That's a liquidity level. Off you go. Since you're using bookmap, you can bring in that insight. No big deal. So
Sure.
very smooth and simple. No moving averages, no nothing. You can enter here, you stop out once, enter again, stop out once, 2 stop outs. When you get it to work, it's 5-1. No big deal.
Hmm.
And that's
Always
it.
do that.
It's slow. I do it like this a lot of times. I do a little differently. I use a bigger time frame, but you can do it like this. It's very smooth. Now, what you got to understand also in this, you will have days where it doesn't give you an opening range. Let's find something like this one. This is a good example. This day, look at the first 5 minutes here. It just goes. No opening range or nothing. What are you going to do? Well, you let it go. You don't have to trade Tesla. There's 4 or 5 other good tech tickers there every day. Look at NVIDIA, look at AMD, look at Amazon. So you can have a very simple trading style where you're just waiting for an opening range, 5 minutes. Okay, don't enter anything inside the first 5 minutes. And doesn't mean you take a trade on the 6th minute. It means you wait until you identify the range and you're firm, you're getting confirmation it's inside the range. Then you wait for a breakout, ideally a retest, and then you go. That should be the way you can trade. And it'll be very smooth and simple. And that's a 5-minute range, huh? That's very smooth, as it's very fast, sorry. There's people who do it on a 15-minute basis, in which case they would have probably caught this kind of move, something like this. So there's different ways to do it. For you, I think remove all the triggers, make your charts look like this, just candles and volume, identify an opening range, and go slow. Really go slow. Use bookmap for a confirmation of your targets. Use the measure move. They should align, ideally. you know where your targets are, and don't enter unless you're getting something like 5 to 1 or 10 to 1 as an opportunity. And then you can enter
Yeah.
2, 3 times and stop out 2, 3 times, doesn't matter. You know, you can easily stop out. You're not afraid of stopping out. The difficulty is if you don't stop out, hold it past your stop, then you're in trouble. So don't do that. Just, you know, where your stop is. There's a reason for it. It's because you know that that's the level and it's giving you a good risk to reward. Then you take the trade. If you stop out, fine. So just
Sure.
do this, you know, and you don't need a go complicated watch list. Just watch 4 tickers these days. That's all you need. Amazon, Nvidia, Tesla, and AMD. Just every day you'll get an opening range.
Mm.
Every single day on one of these four, or sometimes all of these four, sometimes two of them. It's always there. The market's a gold mine, really. It's amazing. There's so much out there. So if you trade like this, what you realize is you've removed all your indicators. Your trading style has become so simple, such that you have 90% of your energy left over to manage risk to reward and manage your emotions. You're not chasing pivot points and moving averages and all those things that are triggering you a lot. So give
Sure.
this a go, and you don't have to wait for the market to open for this stuff. Do it in the sim, or just do it like this on TradingView. This is free on the internet. Just do it here. Just like this. Put on a 1 minute chart. Just go back test. We just did 2 days of back testing right now. Just do it like that. And this is easy. You can scroll the chart. You know, you can just watch it like this. Okay, first candle, second candle. I'm not able to identify a range yet. Third, fourth candle, that no range. Okay, jump it. Off you go to another one. This is back testing right here. You know, you can go through 100 trades like this in 1 hour. Just do 1 hour back testing every day and you'll be fine. Look at this one. Here, opening range. Let's say you put that there. And the first candle, you put it there. Okay, so you know that's it. Where is it? You know that's it. Okay. Second candle happens to break out. Okay, let it break out. Look, retest. Oh, there you go. Breakout, retest. Your distance, well, what's the distance here? That's going to be approximately here somewhere. Check level 2 or the book map. See if it's giving you something at 187, it's a big obvious round number. You can use that as a target if that's really convincing you on bookmap. Otherwise, you have the measured move idea. What's the distance here? You can entry here, tight stop, boom. This happens to be in the third, fourth minute. You know, if you're confident about the range, this one's a very obvious one because the breakout is so firm and the retest is so firm. You can take this maybe the fourth minute. Definitely don't trade the first minute. Okay, second minute's tricky. You can slowly get into it. You can try that instead of a strict 5 minute rule. You have experience, so you can do it.
1 minute range. Sure. Almost.
Yeah. And there you go. Look at that 187. It hit 186. And it looks like 187 will be a target. Well, let's see. It hit 186 with lots of volume. So there was probably, if you looked at bookmap early on, it would have seen a big order at 186. When it hit, it executed, liquidated. Probably would have seen that. Let's say if 187. Yeah, it looks like it's holding above 186. See? Breakout 186 and retest, retest, retest. It's holding above 186. So I suspect 187. There's something going on there. And boom, look, it hit 187 with volume. You don't need bookmap. I can tell you this stuff. It's right there. So there you go. We just back tested a few trades already. Only one ticker. Do this on other tickers and you'll see which it's obvious.
Yeah, man. So yeah, you know, all the time they call it 1 minute opening range breakout, but for me it's just like randomly go in it. So not identify the range.
So do it this way. I'll give you an idea. Okay, drop that 5 minute rule. Do it like this. This will probably make more sense. Identify the range. Do not enter the breakout. Let it break out. Only enter a retest. In that case, you'll anyways be out of the market for 3, 4, 5 minutes anyway, just waiting for that. So forget about the time. Watch the price. Once you're sure about the range, identify the breakout, identify the retest. Off you go.
Yeah.
Now here, I'll give you another example. Let's say on this one, you identified the bottom. This one goes, and for some reason, your perception telling you, okay, that's the new range. Okay. Let's say you're identifying that as a top. Okay. And then it does a false breakout. You're thinking, okay, this is the top. It didn't close above. This is the top of the range. Then you're starting to see it's breaking out. It's closing candle above. It's testing the range. Let's say you enter, you stop out, then you enter, and then this one goes. Okay, that's fine. Nothing wrong with that. Let's say, for example, you identified this as the range. Right? There's no wrong answer here. Finally, does a false breakout, it starts to break out. Okay, it did not give you a retest. Let's say it did give you a retest, you can take this and go. And you have this distance so that if you use a measured move, your target ends up somewhere up here, probably 188. That would be the same distance as here, and you can verify that on bookmap. Off you go. Didn't go in this case. So you're not always going to get it right. But what you want to do is just watch the candles as they form one by one. The simple way, just identify the first minute. And then let the next few candles confirm that. Maybe it'll adjust, maybe it'll be somewhere here. The third, fourth candles will find a top here. Okay, then it'll break out. Then you go. So
So
just
my problem is I never identified the range, and also I was formal, I was thinking that I missed the move. That was the second thing, and the most important thing is I make it more complicated for myself. Even
yeah.
when I want to travel and trading, I cannot because for me, I have to choose everything, have four monitors, all of that stuff. So
No. Keep it simple. See the style. Look, there's nothing in this chart. Shit, man, you can do this on TradingView. Watch the action here and put an order in your phone. I could do that in the airport. It's so easy. It's so simple. This style of trading, all you're doing is identifying the opening range. And typically the first 1 minute candle gives you the range. All the volume, everything's already there. It's very simple. It's a cheat sheet, really. So use that
mm,
first 1 minute candle and then wait for it to confirm. In this case, it confirmed it broke out, retest. Otherwise, maybe for a few minutes, it'll stay in there and confirm, okay, this is the range. Then you wait for a breakout, enter the retest. And you know targets. You can look at bookmap, you can look at round numbers, you can look at measured moves. And just hold for your targets. And again, do not enter unless it's giving you 5 to 1, 10 to 1, something like that. As in it has room
at
to
least
run.
at least 3 to 1, not like half to one. Like
Half the 1 that's not gonna work.
seriously.
No, but I'm telling you, the 3 to 1 is, I'm telling you, is a bare minimum. You should not be taking 3 to 1. No way. No way. It's not gonna be sustainable. Look at this one. Opening range, 1 minute candle here and here. There you go. Breakout, retest, off it goes. Even this one, it works out.
Mm.
That opening range, the first 1 minute candle, the next few candles just confirm it. This one breaks out. Let's say you entered a breakout. You shouldn't. You got FOMO. You entered. Stopped out. No big deal. Then it gets a real breakout. Retest. You can get the retest rate, and off you go. There you go. And the target. Well, use the distance here. Add it up. You find a target somewhere up here. Probably 184.50. Find a round number. Probably had lots of liquidity up there. Nice tight stop and entry. That's 5 to 1. So just try this stuff. And again, I'm telling you, you don't have to do it in the simulator. Do it like this. Backtest 100 trades in 1 hour a day. It's easy. Screenshot everything. All these 5 trades we just tested, just screenshot it. Just dump it into a folder for yourself. Write some notes
Sure,
if you
man.
want. This is experience right here. And you really get a lot of experience doing this stuff offline, as in when the market's closed. So when the
Mm.
market's open, then you can go and apply it. This will be
Yeah,
less triggering, be slow for you, be
yeah,
easy for
yeah. So yeah, even when I see myself, I know the direction, I know how it moves, but my risk to reward is sucks. So I cannot make that much money. See how it goes, man. Hopefully next time I will have a better news for you.
you. You got this. You'll find it. What I've noticed with you, you're very good at picking direction. You've always been good at that. You're just not managing the trade well. So that's what we're working on here. Removing all the triggers that will give you the opportunity now to actually manage the trade, as in only enter when it has a good opportunity of risk to reward, and then hold it, as in hold it to your target, or stop out when you need to. And that's it. All these other things are just triggering you. You're getting excited. The moving average, it's holding VWAP, it's bouncing off something else. No, it's not holding. Wait, I'll hold past my stop. You're doing all that stuff. That's got to stop. So
Sure,
again,
man.
just remove the triggers. You don't have to go and change yourself. Just remove what's triggering you. That's it. And then you got this. You got direction. You know that. That's good.
Remove triggers. That's the
Yeah.
biggest thing. See how it goes, man. I guess I have two homeworks. So remove the trigger, all the moving average, and also working on my mindset about like egoistic shit. And that's more important, I guess. And see how
Yeah.
it goes after that.
Yes, that's very important. Remove all that. Again, this is all offline work outside of trading. Yeah, this is not, you don't need any technical help. It's for you, you don't need that. You need all this to be done outside of trading. It's a matter of how you conduct yourself in your daily routine, building these habits. That's the idea. You've done
Mm.
meditation, so you know what that's like. And that's really good for awareness. You start becoming aware of these are your habits. Now you want to change. Now these are your new habits. You know, you can do that with the self-reinforcement, auto-suggestion, meditation, all this stuff that you always do anyway. Affirmations. Just focus in and build it into your routine.
See how it goes, man. The thing that I really like about you is you're really humble. And this is very good, man.
Oh, man.
So
Well, thank you. Appreciate it. And, well, I
no
don't know any other
problem.
way to do things. I don't. I don't know how to make it complicated. Really, I run away from complication. I've seen all these
So,
indicators, and I was like, oh my god, no way. I'm actually. It's not that I'm humble. It's that I'm lazy. I choose. I like the lazy way.
no,
Slow.
I'm talking about your personality, man. Like that's a good thing. You're really humble.
Yeah, well,
That's
thank you.
good.
Appreciate it. Well, as long as I can share some of that and help people get results, well, that's the whole fun of it.
Perfect, man.
Yeah. So
Thanks,
yeah,
man. Thank you
get
so
in.
much for your time.
Yeah, get in and do it. And hey, listen, join us in the Discord server that we got going on. There's a lot going on in there. The last couple of weeks, I've been trading live in there almost every day.
Oh,
And
really?
there's about 30, 40 of us just coming into the room and everyone's on the mic. We're all just there trading and talking about what we're doing and it's live and it turns into basically a group mentorship session. We're doing it almost every day now. So just come in,
You
bring
do live
questions.
trading there?
Yeah,
That's
yeah.
nice.
Yeah, it's just kind of evolved into it right now. I was gonna do group mentorship like once a month or so, but it turns out it's happening every day. So we're just doing it. I'm just doing it every
So
day.
one thing, so in that there, do you have like a voice or do you like is it I don't know how to use Discord. Like I mean like do you just talk there live or no?
Yeah, I'll pop it up right here on the screen for you.
Because I'm not good at Discord. That's why you know.
Yeah, it's new for me too. I've hardly ever used it before, so just kind of figuring it out. But it's already been very powerful, just kind of doing things in a group, question and answer sessions, live trading sessions, and just various things here. I'll show it to you now. Give it a moment to pop out. Okay. Um, all right. So in here, this is the server, day trading mentorship. We have these text channels.
Uh-huh.
One of them is general, so we just chat anything. Question and answers. People got questions, just put it in there. Anybody will answer, or when I see it, I'll answer it. Watch list. People are just putting the watch list out there. Trade screenshots. Anyone take a trade, just put it in. We have a different chat for just screenshots and trades, trade reviews.
Hmm.
Another one, just everyone put in book recommendations. Started that one just yesterday. This one's really cool. Mentorship videos, where I've got various videos on mentorship sessions and stuff. Like lots of information. So I put that in a separate folder. There's a password for that and all that. So get in there, and the details are in there of how to access it. And then the voice channel. This is where the live trading stuff happens, right here. So you get into the voice, open it up, and it's connected. You're in the voice chat room. There's nobody there right now but me. But when we're trading live, there's many people in here. It's like 40, 50. I think
Oh, okay, okay.
so.
I'll
Just
get
log in
that.
here. Yeah, I'm usually there almost every day. Almost every day that I trade, I show up maybe 10 or 15 minutes before the market opens.
Nice, nice, nice. I will
We're
be
in there,
there.
and basically it's it's like a 2 hour mentorship session almost every day with live
Nice.
trading, questions and
No,
answers and
okay. I
everything.
didn't know that. I didn't know that. I will be there tomorrow.
Yeah. And get in there, yeah, and communicate with me in there. That's where I'm talking with everyone now. So you're messaging me on WhatsApp and stuff. Things can get lost. So I'm doing all the mentorship stuff in Discord now. You can private message me there.
Okay, sure,
Makes it
man.
easy.
Sure, sure.
So yeah, just use that. It's been a great little tool that started recently.
Okay, man.
Yeah, you got a great group of people in there too. So That's awesome.
Okay, perfect. See how it goes, man. So see you there tomorrow.
Yeah, I'll see you soon then. Take care.
Okay, man. Take care.
Bye.
Bye.